Wow, there are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless.
Welcome. Today, we're going to delve into a topic that affects nearly every working Canadian: employment income. We all receive a paycheck, but what does it all mean when it comes to tax time? We're going to break down the calculation piece by piece to understand how the income you earn is translated into the income you're taxed on. It's often a different number than you might expect, and today we'll find out why. So here is our roadmap for today's discussion. We will begin with the foundational tax calculation to see where employment income fits in. From there, we'll define what net employment income truly is. Then, we'll examine some common components like gifts and bonuses before moving to more complex benefits, namely company vehicles and stock options. And finally, we'll bring it all together to understand the practical importance of this knowledge. Okay, let's begin. To properly understand any single component of our tax system, we first need to appreciate its place within the larger structure. Think of it as knowing the rules of the game before you start playing. This is the fundamental structure of the Canadian Income Tax Act for computing a taxpayer's net income. You can see we start by aggregating income from all sources: employment, business, property, and so on. Then a series of specific deductions are subtracted, followed by any applicable losses. The final result is our net income for tax purposes. Our focus today is on the very first, and for most individuals, the largest source of income: employment income. And this brings us to a critical distinction. The amount of employment income reported on your tax return is a specifically defined figure. It is not, I repeat, it is not simply the salary you're quoted or the cash you receive each pay period. This slide illustrates the difference quite clearly. On the left, we have take-home pay, which is an after-tax, after-deduction concept. It's what's left for your daily expenses. But for tax law, we look to the right: net employment income. Notice the calculation is different. We start with the gross salary, but then we add taxable benefits, like the use of a company car, and we only subtract a very limited list of deductions, such as contributions to a registered pension plan. A very important point to note is that source deductions for income tax, EI, and CPP do not reduce your employment income here. They are dealt with later in the tax calculation, mostly as credits. So, let's build on that foundation. What happens with those so-called extras that often come with a job? I'm talking about gifts, awards, and bonuses. How are these treated by the Canada Revenue Agency? The CRA has a very specific policy on this. There is an administrative concession that allows for up to $500 in non-cash gifts to be received tax-free each year. Now, the keywords there are non-cash. Anything that is cash, or can be easily converted to cash, like a general-purpose gift card, is always a taxable benefit. The same goes for any award related to performance. If you receive something because you met a sales target, for instance, its value is considered remuneration and is fully taxable. The rules essentially try to distinguish between a genuine gift and a disguised form of payment. Let's apply those rules to a practical example. Here we have Jeffrey. The company t-shirt is considered trivial, so it's not a taxable benefit. Now, let's look at the gifts: the Amazon gift card, the vase, and the basket. Their total value is $525. Under the CRA's policy, the first $500 is exempt, so only the remaining $25 is taxable. The sales reward, however, is a performance award, making the entire $400 taxable. And finally, the watch for his 10-year anniversary falls under a separate rule for long service awards and is tax-free. When we sum the taxable amounts, Jeffrey has a total taxable benefit of $425 to add to his income. Now, for bonuses, there's an interesting timing mechanism in the Act. Let's say your employer has a December 31st year-end. If they declare your bonus for that year and pay it to you sometime in the first 179 days of the next year, so before the end of June, an asymmetry is created. The employer can deduct the bonus expense in the year it was earned. However, you, the employee, only include it in your income in the year you actually receive the cash. This creates a valuable tax deferral opportunity. All right, let's move into some of the more complex, but often very significant employee benefits. I'm referring to the personal use of a company automobile and employee stock options. When an employer provides an automobile that an employee can use for personal travel, a taxable benefit arises. The legislation is designed to quantify the value of that personal use. The calculation has two distinct components: The first is the standby charge, which represents the value of having the car available for personal use. The second is the operating cost benefit, which covers the employer-paid expenses related to that personal use, like gas and maintenance. However, the rules provide a significant reduction in this benefit if the automobile is used primarily for work. The threshold is 50%. If more than half of the kilometers driven for employment purposes, the standby charge can be reduced. Furthermore, the employee may then have the option to calculate their operating cost benefit as half of that reduced standby charge, which is often much lower than the standard per kilometer rate. This is a crucial test for anyone with a company car.
Let's look at Sheldon's case. He used the car almost exclusively for work, 95% of the time. Because its employment use was substantially more than 50%, he qualified for the reduced benefit calculation. As a result, for 8 months of having the vehicle, his total taxable benefit was just over $1,100. Without meeting that primary use test, this figure would have been considerably higher. Employee stock options introduce a multi-stage taxation process. When the option is granted, there are generally no immediate tax consequences. The first major taxable event occurs on the exercise date, which is when you actually purchase the shares. At this point, the difference between the fair market value of the shares and the price you paid, your option price, is considered an employment benefit and is included in your income. Then, a second taxable event occurs when you eventually sell those shares. This gives rise to a capital gain or loss. Now, to avoid double taxation on the same economic gain, a critical adjustment must be made. When calculating your capital gain upon selling the shares, your cost, or what we call the adjusted cost base, is not just the cash you paid for them. It is the cash you paid plus the amount of the employment benefit that you already included in your income. This ensures that you are only taxed on the capital appreciation that occurred after you acquired the shares. It's a fundamental principle of fairness in the system. There is also a very valuable deduction available that can make stock options particularly attractive. If certain conditions are met, you may be entitled to a deduction equal to 50% of the stock option benefit. The primary condition is that the option price must have been at least the fair market value of the shares when the option was granted. In essence, this deduction aligns the taxation of the employment benefit with the preferential treatment given to capital gains, effectively cutting the tax on that benefit in half. So we have reviewed quite a few technical rules. But what is the practical application of all of this? Why is it so crucial to understand these details? Well, it really comes down to this simple truth. A thorough understanding of how your total compensation is taxed is the bedrock of sound financial planning. It allows you to evaluate job offers not just on their headline salary, but on their total after-tax value. This knowledge empowers you to make informed decisions that can significantly enhance your financial well-being over the long term. Let's summarize the key principles from our discussion. First, remember that net employment income is a specific tax calculation distinct from your take-home pay. Second, the $500 gift rule only applies to non-cash gifts and awards that are not performance-related. Third, the timing of a bonus payment can create a valuable tax deferral. Fourth, the personal use of a company car always has a tax cost. And finally, stock options trigger 2 separate taxable events, an employment benefit upon exercise and a capital gain or loss upon sale. So, with this framework in mind, I'll leave you with a question for reflection. The next time you evaluate your compensation package or consider a new opportunity, which benefit will you now see through a different lens, knowing how its true value is measured by our tax system?